I'm Bill Neville with the Entrust Group. Thank you for joining us, and you're going to have me and Verlin Gradney, who's going to talk about investing in early stage startup companies. So it's going to be an overview, basics about how to do that. I'm going to talk for about 5 minutes about Entrust and self-directed IRAs, and I'm going to hand it off to Verlin, and he's going to take over. And then we're going to answer questions at the end. So feel free to type all your questions in the chat box. You can type them now. You can wait till the end, and then we'll go through them all, and we'll answer every question that gets asked. So let's go ahead and get started. So before, as I always do, if you're a regular with these, we provide this a little bit of information in that Entrust Group, we are a custodian and record keeper of self-directed retirement accounts. We do not give advice. We're not CPAs or attorneys. So before doing any investment, we encourage everyone to seek the advice of someone qualified or in your life to do that, but it won't be anybody at Entrust. We don't give advice. A quick overview of the agenda. Again, going to talk a little bit about Entrust, and then I'm going to hand it off to Verlin, and he's going to give you an overview of early stage investing, what the due diligence process should be, what the difference is between investing in early stage privately held companies versus publicly stocks, the pros and cons of this, and then again, like I said, we're going to have a Q&A. And I'll say it again, feel free to type in your questions in the chat box at any time. We'll answer them at the end. That's me. I've been, actually, we're gonna have to pray for my next presentation. We'll have to change that to 11 years at Entrust. I got my anniversary coming up in a couple of months. My role is just to educate people about how to invest in alternative investments inside a retirement account, non-traditional assets inside retirement account. And I'm graduated from Penn State University. And about Entrust, we've been in business for over 40 years. We're actually, the anniversary of the company is pretty close to my anniversary. We'll be at 41 years soon, or 42 years actually. We have about $4 billion of holdings. We have approximately 22,000 accounts, and the big difference between Entrust and our competitors, most of our competitors, that we provide you a single point of contact. So instead of just having, if you have an account with us, instead of just having an 800 number to call, you have a business development manager, me or one of my counterparts, and then we each have an associate that reports to us. So you get a team of 2 people as your single point of contact when you establish an account with us. We are custodians and record keepers, otherwise known as administrators of self-directed retirement accounts. The majority of our staff is certified IRA service professionals. We have offices throughout the United States. We are headquartered in Oakland, California, but we also have offices in New Jersey and in Tennessee and Nashville and in Southern California. We do in-person events as well as virtual events. So if you want to have anybody speak, if you're an investment sponsor, maybe a realtor, CPA, somebody like that, want to have us speak, we can do that. We also have a national continuing education program that offers credentials, CPE credentials, and trains for certified IRA service professionals. We're the only company in our space that has these credentials that does that, and we have a twice-a-year IRA Academy. Again, that's where we essentially train competitors of ours, people in our space, all the information they need to know about retirement accounts that prepares them to pass the Certified IRA Service Professional class. What exactly is a self-directed retirement account? First, I'm going to tell you what it's not. It's not a type of account. A self-directed IRA is the description of the service we provide. So the type of account is still traditional IRA, Roth IRA, SEP IRA, 401k. We also have a health savings account, a Coverdale educational savings account. Any of those types of accounts that you open with us is by definition a self-directed retirement account because we are a self-directed custodian. Self-direction is a definition of the service that we provide. which means that you, the individual investor, are in charge of making all your own investment decisions. Again, we don't give advice, we don't sell you investments. You have to take control of what you want to invest in, but it allows you to invest in non-traditional assets. And a non-traditional asset is anything other than a stock, bond, or mutual fund. So it allows you the opportunity to diversify outside of just stocks, bonds, and mutual funds. But all securities, all investments, in order for a retirement account to qualify as a retirement account, all investments are required to be held by a financial services company, a custodian. And so we have our own trust company, the Entrust Trust Company, that acts as custodian. The Entrust Group provides all the record keeping services. So in order for that to happen, you still have to have your account with a financial services company who acts as custodian and record keeper for your retirement account. And that's what Entrust does. Before we get too into this, we'd appreciate if you could all answer this poll. Have you ever invested in a startup or early stage company, whether personally or inside an IRA? And simply answer yes or no. And Verlin's gonna appreciate knowing this information in terms of how he does his presentation. So with that being said, I'm gonna pass this off to Verlin. I'm gonna close off my my webcam, and then I'll bring it back up. And there's what we got. So 64% of you have invested in an early stage company. Cool. And 36% of you have not. All right, Verlin, your turn to take over, and I'll be back. I'll bring my webcam back up whenever we get to the Q&A portion.
Awesome. Thank you, Bill. And thank you everyone for being here today. My name is Verlin Gradney. I am the founder of Mindset Startup Academy. And I'm going to be your host today for a pretty loaded subject matter, but I think we'll do a pretty good job today of at least breaking out the high points of evaluating early stage startups. And thank you for completing the poll. I think it was north of 60% have invested in this, so that's good. And what I'm going to focus on today a little bit is some of the things that we are developing for existing startup investors, but I'm also going to kind of tilt this a little bit for any of you out there who have maybe been sort of on the sidelines or thought about it before. The key focus of today is drawing correlations between how we evaluate traditional listed securities in the market, such as maybe mutual funds or stocks, and the way we go about analyzing and doing due diligence on private early stage companies, sometimes still at the very conceptual level. Believe it or not, there are a lot of correlations, and that is one of our primary focuses. So before we get started, I'll give you a little bit of background on myself. I'm very passionate about working and educating with accredited and non-accredited investors, particularly because of my genesis. So I started in the finance industry, running SEC RIA offices for family offices and endowments, plenty of wealth management experience, financial services, and then I moved that into structured finance and then into venture capital. But my focus for many years was always Series B and beyond. That's at a point where an early stage company could actually be considered approaching a middle or later stage. Most of the hypotheses are pretty much flushed out. Revenue is very strong. And about 6 years ago, we decided to start dabbling as angels, like just 60% or so of you out there. And we loved it. Maybe call it a change of pace. For me, it was the idea that if you spend a lot of time in the institutional space, Series B to pre-IPO, it's great. Hopefully I won't offend anyone here on the call, but it can get a little boring. And what I really liked, I found about working with startups was I got an opportunity to really focus on what I love to do, which is educate. And so we decided about 2018 that I would create an exploratory committee for the purposes of whether or not we would build a co-investment fund. And I'm going to share this backstory with you because it just gives you a little bit of kind of where our head's at, and I think it will make sense and context for what I'm going to share with you today. I'm a very evidence-based investor. That's qualitative and quantitative. Not all of it I can touch, see, feel, or quantify, but to me, it's still evidence. So what that meant was we were going to create an exploratory committee to meet the neighbors. And we met with hundreds of early stage funds, hundreds of founders, went to dozens of startup events. And what a lot of the early stage investors were curious about is, what did these guys think of the startup space? And what ended up happening was I ended up, and I'm going to show you on the next slide, what we thought were some of the shortfalls in the startup space. But it is important for you to note that what I created in Mindset, it's a free community for both supply and demand. Okay, you're going to hear me mention these supply and demands, typically economic terms we're used to, but in the context of today's discussion, I'm referring on the demand side as all early stage companies out there, and we'll define what early stage means in a second. And then the supply side would be all of the professional early stage investors. Okay, so these are your angel groups, angel networks, micro VCs, venture capital firms, institutions, organizations, and or collectives that come together with the sole purpose of creating systematic investments within the startup space. And just to give you a little bit more context, there's roughly 5,000 plus early stage professional investors that as I just defined them in the United States. And so as we began to identify structures, what I decided to do was actually create an online community for founders where I actually go out and interview the fund managers. So I'm very proud to say that as of we stand here today, I've interviewed almost 2% of the entire US audience of professional early stage investors. And the topic every single time is on the process of investor due diligence. And the reason for this, it's kind of like writing a book. What I'm doing is I'm sort of compiling all the different opinions and perspectives, because so much of this is subjective. And what we're really excited about for the first time is we're going to begin here in the next year of actually culminating this data, which has never been done before. We're getting incredible support, even such as friends like the Entrust Group, and letting us describe this. So do know a lot of the things that you're going to be saying today is not Verlin standing on the mountaintop and saying, this is the way I believe that it is, follow me. Everything that we're doing is really documented and backed up by over 100 different interviews that are on our YouTube channel or on our in our Slack community for our founders, and really beginning to piece together what is it about the investor's mindset, what is it about that decision matrix, the way that they make investments as it relates to early stage companies. As we were working out this thesis, this concepts of investor due diligence, and I'm sure for the 60%, north of 60% here today who have invested, you did some level of due diligence, but here's the significance of it. It is something that isn't being taught until Mindset came about for the demand side of the equation. But the really interesting side for us, since we're on the supply side, is focusing on teaching the concepts of investor due diligence, because what it allows us to do is it allows us to expand our own networks, find other like-minded individuals, some professional, some accredited, sometimes even non-accredited, and for the purpose of actually compiling additional opportunities to meet the demand. So why is investor due diligence so important? You got to realize one key thing. In the United States, these 5,000, approximately 15,000. The really interesting thing is there has not been any single party or entity who has ever quantified how many people are on the demand side of the equation at any one time. As a supply side member, and we talk about this with a lot of funds, we can invest in companies that can theoretically pop satellites in the air and move light rays around, but we have not decided to quantify our demand side. Here's what we do know. Hypotheses from most funds believe that there's anywhere between 100 to 150,000 people each year on the demand side between the pre-seed and the Series A space, which we're going to cover in a second. Industry-wise, you've got roughly a below 5% success rate of those companies that actually get funded. Now, here's the key thing that I want you to think about. You might be thinking, why is he going down this particular hole? Because I'll bring it back with a callback in the end, I promise. But put yourself in our shoes as early stage investors, professional early stage investors. We see 1,500 to 2,000 decks a year. All we're really getting is about 14 slides and a short description. And we have to determine, based upon time, what 10, 15, or 20% of those decks we're actually going to move on to our calendar and actually begin to meet with, at least initially. From there, we're going to whittle that number down even more through the investor due diligence process. And then on the other side, we'll then make our decisions on which ones we invest. Here's the key problem. If you have a lot of founders out there with tons of great ideas, and let's say a lot of good portion of them are first-time founders, they've never done it before, they've got the pitch deck, they've got their pitch down solid, and then they actually find someone like me or one of the other 5,000 that are actually very interested. If they're not familiar with the process of investor due diligence, put yourself in their shoes, in their own mindset. It's like sitting for a final exam and you've never even showed up to class. You've never had a syllabus, you've never even cracked a book. And so what we believe of why investor due diligence is so important, and how this correlates to the way that you probably make investments in the listed securities market or in the alternative investments market, is that we're not getting the best of these founders, okay? And we believe if we start focusing on really what is investor due diligence and how it can be utilized on the demand side and the supply side, what we believe we can actually do is we can start increasing the number of opportunities that are there, because the demand side better understands what they're about to go through in the investor due diligence, which we're going to describe in a second. Next slide, Andrew, please. So a little bit of background on early stage startup community. As I mentioned, you've got roughly 5,000 professional investors, approximately 100,000 companies. Success rate, depending on who you actually talk to, can range anywhere between 5 to 8%. Next slide, Andrew. Now, here's a key question that we talk a lot about with, and the 60% north or so that have invested have been some of you who have yet to have probably heard the term early stage or pre-seed or Series A or all of these terms. Here's the reality, and I feel that I'm in a pretty strong situation to make a comment like this, since I think I'm one of the only ones out there that have interviewed this particular mini VCs. Most of these terms are incredibly diluted. They started off with a really strong purpose, and we've really sort of kind of made them our own. But for today's conversation, the way that we'll define early stage, as you see here on the screen, refers to those companies and founding teams who are considering, preparing, and or conducting an early stage raise. An early stage, we're going to define what that particularly means. But it's a key thing here and a key distinction that sometimes goes right by us. Notice we said considering, preparing, and or conducting. Part of our process on the supply side is much like an opportunity that you have in your alternative of real estate or your alternative opportunities out there in the listed securities market. If you can get to an opportunity before everyone else knows about it, and you can do your homework and get in early on the ground floor, as they like to say, it's even better. Well, if you're waiting for an early stage company to be conducting, chances are they're already on the radar. So the industry is really moving towards platforms, and this could be utilized by individual investors like yourselves as well, of how do I get further downstream? How do I find those opportunities before everyone knows about them? We've interviewed funds like 1517 Fund or Peter Thill's fellowship model, where they literally hang out on college campuses. You can't get earlier in the genesis of an idea than when the founder is literally getting out of class and drawing notes on a sheet of paper. So early stage isn't just the companies with a polished tool. Early stage is really becoming anyone that has intention and or is actively seeking capital from professional investors and or individual accredited and non-accredited investors like yourselves. Next one. Now, here's one of my favorite things. What the heck do these terms mean? We've all seen them. Every week there's not an interview that goes by that I don't ask them their opinions on these. And usually what you see is a little bit of a chuckle. They will all agree that they're pretty diluted, and then they will give their spin on what it means. So I'm going to go ahead and provide you an opinion that we've compiled based off all of the funds that we've interviewed on what these terms mean. It may be different than what you may have heard. There is no right or wrong answer. These are very subjective things. So this just comes from our experience. One of the reasons why I wanted to do the interview process over the last 2 years is to give some real strong empirical evidence to this. But this is where the rubber begins to meet the road as to the comparisons, in my professional opinion, between startup investing and that which we do in, say, your retirement planning of listed securities and alternative investments, okay? If you look at those that are considering, preparing, or conducting a raise in early stage, the industry's essentially created 4 buckets. And these buckets sort of work in a chronological pattern, okay? And they also have their own characteristics and prerequisites. And then when we, as the supply side, decide to create a fund or create a collective of like-minded individuals, typically what we're doing is we're setting some constraints to our investment philosophies, right? What are we going to do and what are we not going to do? These are very key things for professional investors, but they're also very key things for individual investors like yourselves, is setting what the game plan is. So in the way they go about, or we go about setting what we're going to do and not going to do, is we'll typically define the stage of the business that we're interested in. So funds will say, you know, we're open to conceptual friends and family. We're open to only seed or Series A. And then the second component they'll do is they'll give their industry or sub-industry tilt. So I am a pre-seed investor interested in SaaS, software as a service. or I'm a seed and Series A investor interested in fintech and insurtech, whatever it may be. Starting here on the very left, friends and family. This is actually the largest source of capital in the United States as it relates to businesses. However, much like the fact that we've never really quantified the demand side, we can't really quantify what friends and family is, because most of it is kitchen table type stuff, as I say. It's literally the friends and the family, and it's a couple bucks here and it's a couple bucks there. We estimate it somewhere north of $30 billion. Most professional investors agree that friends and family actually far exceeds pre-seed, seed, and Series A combined. The problem is it's a black hole for us in the industry, okay? This is typically where an idea is at conception. There is an individual, maybe a couple of individuals, and typically they don't have anything other than a well thought out laid plan on paper. And so really it's the most difficult job of raising capital. However, it is also one of the greatest opportunities, if you think about it, if you make the right bet, and I use bet very clearly because that's essentially what it is at that particular point, then the opportunity of where you get on your cost basis and where it could potentially exit is obviously much larger. Then we move down the road to what we call pre-seed in the industry. Now, this is a particular point where we're past conceptual. The team has probably gotten a little bit larger. The corporation has been founded. The capital raised from friends and family has at least typically begun focusing on building some type of MVP, as we call it, most viable product, otherwise known as a prototype, okay? So what they're doing here is they're taking that capital that they can raise in friends and family, that is basically sometimes an idea on a napkin or maybe a PowerPoint, and they're churning that concept into something that investors can see, touch, and feel. And in that process of pre-seed, if they're fortunate enough, not only can they be capital efficient enough to build the widget, but they can also be fortunate enough to take that widget and aim it at their potential target audience and begin gaining feedback, okay? So obviously, if they can get to the very unique stage of building a widget and gaining feedback, the better for investors, because there's more meat on the bone there to analyze. And in a very rare opportunity, pre-seed companies can actually churn that introduction of their widget to their target audience to actually early levels of revenue. It's a little rare. It's not a high expectation from the supply side, but it's a bonus and a cherry on top if you actually can. Now walk that road down the middle of the road a little bit more to seed stage. What are we looking at here? What we're looking at here is we're looking for that MVP and prototype to become much more formalized. We don't want pilot test, we want actual early stage sales where you're beginning to truly test the hypotheses that you laid out in your business plan. And we want to see you and that capital that you raise begin to make some very critical decisions and tweaks, or pivots as people like to say, to your original hypotheses, but you're actually beginning to generate some real revenue. There's real critical feedback and knowledge coming back through that feedback loop. And then the Series A space, should companies be fortunate enough to get here, is where most people think of startup investing, is the Series A space. Why? A majority of those 5,000, when they set their parameters of what they want to do and not going to do, they typically sit between the seed and Series A. It's a very luxury. Most of the big VC funds you know of sit in the Series A space. What is the Series A investor looking for? He's looking for everything that came in the initial 3 buckets, except they're saying very critically, and it can be incredibly discriminatory and it can be incredibly rude and in your face. Hypotheses are done. We like the empirical evidence. We're going to put a heck of a lot more money into your gas tank right now. And we want all hypotheses done. We want those particular aspects that we're working, and now let's scale. So those are very critical stages, okay? And when you're a founder and you're moving through these buckets, okay, every time I like to call what you're seeing on the screen between friends and family and Series A a cross-country trip, okay? You're going from LA to New York. How you map out that trip and where you need to fill up with gas, you could have 100 people taking that trip and 100 different ways that you're going to get there and 100 different types of gas stations. That's okay. That's for the investor or the supply side to determine whether or not they jive with that model. But every time they successfully raise one of these rounds, you have to realize that capital, since the majority of these, they're not generating revenue, at least not enough to maintain OpEx or growth or R&D. That capital they raise in the bucket is only lasting them on average in the industry 18 to 24 months. So every single time you invest, you have to not only believe in the idea of where that person is at, understand whether or not they actually have a good understanding, but then you have to look at the game plan that they laid out for the next 18 to 24 months, and you have to do three things. Is that set of assumptions that they've laid out for the next 18 to 24 months, is it going to build more value, proving out that they can continue this at scale? Is it going to be enough value that's actually going to raise the valuation a little bit so we get a step up in cost basis, right? Just like we're used to in our normal investments. And is that proof in the pudding of their assumptions combined with an increase in the actual valuation of the company as a result of those correct assumptions, is that going to entice enough investors at the next gas station? Because if they don't entice the investors at the next gas station, guess what happens to my investment in the business? It's flatlined. Very few companies can leapfrog their way through the four buckets I'm showing you without filling up on gas in each one. There are anomalies, right? You take something like Instagram. Instagram never even loaded a picture before actually Facebook bought them. A lot of people didn't know that. They were still sitting in your friends and family in pre-seed when they got bought for over $1 billion. It can happen. But a majority of the time when we're early stage investing, you can follow the same very principles of talking about what are you willing to do and not willing to do, and then moving through the process. Next slide. Okay, so the types of early stage investors and the diversification tilt. When we preface the early stage, this includes the venture capital, as I talked about earlier, the micro VCs, accelerators, incubators. It's not uncommon for funds to have one or two particular buckets that we described as their focus. And it's also not uncommon for them to have multiple types of industries that they want to fix. But what's interesting about the way that they do this is look at mutual funds that I'm sure many of you have somewhere in your qualified accounts. We all became very familiar with the idea of growth funds and small cap funds in emerging market, right? And we also became very literate with the fact that there are differences. And those differences typically lean into risk and what that risk means in associated return. We understand what those data points mean in terms of volatility, and we understand what those data points could potentially mean as market trends or situations shift, right? We're very familiar with that. So when we build our Harry Markowitz asset allocation theory and we decide which particular buckets of capital we're going to put our funds in based off our overall risk tolerance and goals, take that same line of thinking and then look at those four buckets I just showed you. It's one of the really cool geeky when focusing on investor due diligence is pointing out the similarities in what these different types of investors are doing. If you look at friends and family, very early stage, that's just like a lot of the small cap stocks that had a lot of high volatility, or some of the world high yield fixed income stuff that had all kinds of volatility. And as you move up to those Series A spaces, it's kind of like moving from the small cap, mid cap to large cap, right? It's kind of like moving more to the blue chips. They're kind of like aircraft carriers. Are they going to have the large jump up, statistically speaking, in valuation that say friends and family or pre-seed? Theoretically not, statistically speaking, but it also comes with a lot more risk. So when we on the supply side are building out our do's and don'ts, we're actually following the same line of thinking that many of you, I'm sure, and most individuals working with advisors lay out as it relates to their household value of accounts that they're actually managing. And the combination of those characteristics will hopefully blend in a way that will get us to our goal. So again, another line of similarity if you're kind of looking at how to build a portfolio of early stage companies over time, chances are it's probably very similar to the way that you're building your overall portfolio now. We just have to exercise a few different muscles. Next slide, Andrew. Now I want to break down for you the process of investor due diligence, okay? Because this is my expertise in this one, but this is a really bloated term. Andrew, if you can go to the next slide for me. Hopefully I won't get too much in my passion box here, but here's what I want all of you to know about investor due diligence, because this is something that you can all do on your own. But as I said in the very first slide, this is where the game is won and lost, right? And I don't just mean on the demand side. Excuse me. I don't just mean it's won or lost because founders are sitting for the first exam they've never studied. Yes, that's true. but it could not be more true on the supply side of the equation as well. This is where our investments actually win or lose, is in the investor due diligence. Now, what does this process mean? Here's the really interesting thing. I'm interviewing so many funds and about 50 funds throughout Europe as well. Globally, when it comes to how we conduct investor due diligence, we all sing from the same hymn book. It is the same 10 to 11 macro topics. It's the same few hundred data points, qualitative and quantitative. What is unique about the startup industry is every single one of those data points is subjective, okay? You put 5 pre-seed fintech investors in the room, and you'll get 5 different opinions on the recipe that it takes of those data points to reach success. One will say, oh no, you got to get to them early. Don't worry about the revenue. Give me a A+ product with a C+ team, and I'm happy. The next investor goes, no, you got it totally wrong. You need this much revenue. You need this much market penetration. It's not about the product. You need a better team. This is the type of stuff that goes on, but here's the commonalities. We're all using the same data points. They're just incredibly subjective. And so when you are analyzing a team, they just made their pitch to you, and you look at it and you're thinking, okay, I'm kind of familiar with this industry. This is kind of interesting. A professional investor, and I always recommend individual investors just follow the professional investor's lead, is they're going to put them through the paces, typically over 5, 6, 10 meetings. It's going to require a heck of a lot of data, and they're really going to push and test the founders. But here's the key thing, and we've proven this out through the interviews. If a founder can sit down with us, or any fund manager, or even yourselves, and they can have those level of detailed conversations over many weeks and not talk about products and services, that person is adjusted. What do I mean by that? Founders are very used to pitching. Go back to what I talked about, 1,500, 2,000 decks. Every single one of them tells me they're the best thing since sliced bread, and they're going to change the world and come along, and if it's only 1% market penetration, we're all billionaires. So what are we, if everyone's saying the same thing, then what are we doing in the investor due diligence process that we're making our decision? The one thing across six different countries we've interviewed now, they all said, whether between friends and family and Series A, 50 to 60% of their investor due diligence process is not the product of the technology, it's the person. Many of you know this, it's the team, it's the human capital. It is what Warren Buffett used to say once upon a time when he still invested in individual stocks the way he used to. You can give me all the empirical evidence and spreadsheets you want, but until I land on the ground, kick the tires, see the middle range management, see the C-suites, and make an assessment on them, those numbers you gave me have zero context. It is the exact same thing of investor due diligence. We're not a bunch of sadistic people that want to put founders through the paces and watch them sweat. We've got better things to do. So the question is then, why do we do it? What's in our mindset? We're like Warren Buffett says, they're throwing a bunch of data that is majority hypothetical. What we do know, constant at all of us as in our lives, is 50% of the stuff you say is going to happen is not going to happen. It's not a knock on you. It's not a knock on your idea. That's life. So if you're sending me a bunch of assumptions and I know that 50% of that stuff's not going to be true, then what I have to do is I have to invest in that founder's decision matrix. Meaning I need to unpack the hows and whys you made those assumptions. Remember back when we were in school, when you were learning math, and if you were like me and you didn't get a calculator, I would get the right answer and she said, well, okay, that's great, Verlin, but it doesn't matter. Go back and do it the way we showed you. The purpose was so that you knew the fundamentals. What we're doing in investor due diligence is we're seeing if you truly understand the nature of those assumptions you made. Because if I can jive with the way that you think and how you got to those assumptions, then I can feel comfortable that when you get 50% of those curveballs down the road after we put $2 million in your gas tank, I can feel confident that when you face one of those, you're going to have that same decision matrix as me, and you're going to modify, shift, and or pivot that particular situation in a manner which is best suited for the business and me, the shareholder. That is the purpose of investor due diligence. If I can say it enough for everyone, it is not about how fancy the product is. Sometimes it could be, there's always exceptions to the rule, but it really comes down to the team. If you understand the market and you understand the product and you truly believe that they're presenting a value proposition to that audience they say they're going to target, then we have to get 100% comfortable with the team that's around and whether or not they have the background, skill sets, and complementary skill sets and attributes to actually pull that thing off. And it's okay if they don't. As I said earlier, there are certain funds that truly believe, hey, give me an A+ product and a C+ team. I can fix the human capital. But a majority of professional early stage investors say, hey, give me an A+ team and a B- or C+ product, and I can make that work. I can't fix grit. I can't fix instinct. I can't fix or teach what it takes sometimes when it feels like everything around you is crumbling and I've got $5 million on the line that I can draw clarity and move forward. So it's about setting what is important for you and what is your recipe. Remember I said you put 5 particular pre-seed fintech investors in the room, you get 5 different opinions. That's okay. It's not for anyone to say who's right or wrong. But if you're going to invest, or if you're thinking about investing, expand beyond, set your parameters. Do you come from the healthcare space? You see a lot of times individual investors are familiar and comfortable in that space. Sometimes individual investors will invest in companies they have no idea about the industry, but they're really good at reading people. Figure out what it is in all those data points that you feel you're good at analyzing and that you feel are the highest proportional attributes to success, and you start to utilize those to build your recipes. Next slide, Andrew. Deal flow for most professional early stage funds is kind of alarming to most people, I think. It is, as I said earlier, about 1,500 to 2,000 slides a year. It's a lot. And when you are a pre-seed fintech, imagine you get 150 of the same stage of the same industry coming through. Trust me, they all start to look alike very quickly. So if you ever happen to find a particular niche or focus and you kind of look at statistical averages like these, it isn't uncommon for a lot of investors, and maybe some of you that were in portion of that 60% that are involved in angel groups, because it is important if you are looking to actively pursue a proportion of your portfolio in startups. Deal flow is a very key thing, because if you do set those parameters and constraints that you really hold a lot of conviction to that you're looking for, trust me, it's going to take a lot of decks for you to find that one that at least correlates 80 to 90% of the ingredients in the recipe that you're looking for. So if you don't feel that you can kind of create a lot of that flow, then sometimes we just have to be patient. Or sometimes what we do is we plant our flag with another institution or a group or association that we know that has a little bit more exposure and presence that can supply those opportunities on a systematic basis. Next slide, Andrew. So now let's kind of bring this into focus. I've talked a lot about how we operate on the supply side as professional investors, but I'd like to kind of circle this back to what those primary principles are we use primarily in the venture capital space, and how individual investors, as I kind of touched on a little bit, can really start to culminate these ideas. Startup investing is never going to be, I think, the risk-free option, right? There's always going to be much safer bets. So a lot of times with riskier, and I kind of almost look at startups almost like an asset class, if you will. Andrew, can you hit the next slide for me, please? I kind of look at startups as an asset class from a very macro perspective as it relates to risk and return. And a lot of times you have a very risky asset class, unless you've got a really high risk tolerance, you're not leaning too heavily into it, but a small proportion can actually make a big difference. But again, it's about this investor due diligence process. IDDs, as we like to call it. IDD process are typically comprised of about 5 to 6 individual meetings, okay? With plenty of email communications back and forth. Before each meeting, there's usually a data dump process. So what I'm getting at here is, if you follow these particular principles that we use in the professional early stage space, and as I said before, you kind of set your constraints. What are the data points that are key to you with conviction? How do you put those data points together into a recipe that you think is appetizing and fits with the other makeup of your comprehensive portfolio? Then the next thing that you got to do is you got to kind of build out what's your investor due diligence process. And a lot of times when we've worked with a lot of different RIAs and working with some of their individual investors, what I begin to notice is that it's not about how I run an investor due diligence. It's about how you believe you need to run your investor due diligence. Sometimes I'm in presentations or groups or symposium or events where people are telling individual investors, you got to do it this way. I don't think that's bad. But the spirit of what I'm trying to get across is go back to what I said earlier. What's the purpose of investor due diligence? I'm sure you have much better things to do with your time than to watch a founder squirm because they don't know the answer. That's not it. The real goal of how you build your investor due diligence process is to get down into that founder or founders' minds and understand their true understanding of those assumptions. Do they truly understand the market? Do they truly understand the competitive landscape? Are they doing like a lot of us say in the industry, are there flags on the field as I'm talking to them, or they're making certain comments that aren't jiving? So investor due diligence doesn't have to be grueling. And here's a perfect example for it. A couple months ago, we interviewed a fund that is in a very competitive space as it relates to telemed and health tech. And they were having a real problem getting through the amount of deals because via COVID and pandemic, you can imagine the amount of pitch decks that started coming through. So they modified their investor due diligence. And this is an example, you kind of make it your own. And what they did was they said, okay, what's the most crucial data point for us that we have to have strong conviction on, that we jive with this person on? And you want to know what they came up with? It was competitive analysis. Because here they are in this emerging asset class called telemed, that they can only assume a logical person would assume that it's going to grow and compound dramatically. Competition is going to be through the roof. This person has to understand that. So you want to know what their investor due diligence test was? And again, this is grueling stuff, and it's not meant to hurt anyone's feelings, but this is the big boy league, is when the founder sits down, he starts his pitch, they stop him. They say, before you move on, for the sake of everyone's time, we need you to do something. And they slide a piece of paper across the desk, and on that desk, on that sheet of paper, I mean, is all of the competitors that are within that person's market. They've already done the homework. And they'll say, this is crucial for us to move forward at all. Can you please pick 3 of them and tell me every single thing that you know about them? Now, that's a very straight in your face approach. That's a team that needs to move through opportunities. But the point that I'm making is, rather than going through 5 to 10 meetings, what they did is they put a precursor out there first to say, which particular aspect am I most requiring of a founder to understand? And we're going to start there. And if they can solve that particular piece, then we'll move forward. So creating your own investor due diligence process doesn't have to be robust. It starts first with, where are your primary data points that are crucial to you in the way that you want to invest and pull them together? And then the next question is, how do I pull that, extract that data in a logical, professional manner from an individual or set of individuals in the most efficient use of time as possible? Next slide, Andrew. Brief overview of what a typical IDD process entails. Okay, so all right, Verlin, so you're telling me to zip into the data points. Well, what data points are you using? You referenced 11 to 12 primary topics, 100 to 150 data points. Well, you're looking at them here. These actually happen to be the primary topics. No one's ever written a book that said these are the topics of investor due diligence. So we had to compile this by talking to about 2% of the market. And here, particular concepts that are all made up within the business plan. And we're going to provide you a copy of this particular deck. So I'd really zero in on this particular slide, because here's something very interesting. When startups are pitching, what are they always doing? They're talking about products and how great the tech is and we can penetrate the market. Look at the topics of investor due diligence and look at how many are about product. 1. That's it. Because it's not the product and the tech or how cool it looks that gets us to the promised land. What it is everything surrounding that particular product or service, how it enters the market, how it interplays with other competitors, how it continues to scale, and how it continues to add value. And so investor due diligence is oftentimes saying, okay, that's great, you got a cool idea. Let's go over here and let's understand your level of market awareness and what are your opinions about where the market's going to be. So some assessing the leadership team, hands down, I don't lead any fund. 60% of the interviews we've done is on investor, how we assess the leadership team. That's what they want to talk about because it's important to them. Some funds will look at it and say, hey, teams I can fix, but it needs to be a big enough market. Okay, so I'm very opportunistic. So some focus on market size opportunity. Some focus on what we call ideal client profile, or ICPs. That is who your target audience and individual is. So a lot of funds want to see that you know that person inside and out. Translation in the business, they were looking to figure out whether or not you made a cool product and are now trying to find its home. Or did you understand the problem and then build the product? That's what a lot of these topics are doing. roadmap and value propositions. Can you create true customer pull? What's the competitive landscape that I just gave you? Market strategies. Here's a big one for competitive. If you're looking at fintechs and insurtechs, a new thing inside of market strategies is offensive and defensive. What do you think most founders want to talk to you about? They want to talk to you about offensive, how we're going to grab customers and market share and grow revenue. And then all of a sudden we flip the script and we say, okay, now tell me about defensive strategies. You're now on the radar and you've got a competitor and they're trying to price cut you. Talk to me about the defensive strategies. And then it's crickets. It's very few founders have the opportunity or understanding of how to forecast what defensive strategies are. So you can have the greatest offensive strategy in the world, but if you're not protecting our market position, then you're bringing down the valuation of that company and my investment. Investor risks, that could be everything: market risk, regulatory. Sales assumptions, the biggest flag on the field is sales assumptions are too aggressive, okay? So one of the things I always recommend for first-time individual investors is focus on the sales assumptions, and it's Goldilocks. Is it too hot or is it too cold? Did they go from $500,000 of revenue in year 1 to $20 million in year 3? That's a heck of a jump. Let's unpack that and figure out why. I'm not saying it's impossible, but sometimes founders have a tendency, particularly those who understand the way the game is played, to adjust the sales assumptions so that the valuation in year 7 to 10 is correlating with where a majority of us would like to see it for us to meet our fund numbers. So we're a little bit hip to the game on that, so we don't want to fall for that one on the sales assumptions that are engineered via a timetable to work out perfectly for our math. Same thing for revenue forecast, and then valuation capitalization. What that basically means, this is one of my primary components, guys, is understanding that cross-country trip. That's just absolutely crucial for the way that I invest. I think it's a major blind spot for most founders in that they can describe to me their next gas station or two. They have a very difficult time explaining what gas station 3 and 4 are going to look like because it's potentially 4 to 6 years away. And I understand. I'm not looking for the right answer. I'm looking for your thought process and how you go about analyzing something as abstract as that. Because if they have the level of detail and they're using the right pillars, they don't know what the value of that pillar is. They can't. Their crystal ball's broken. But they have acknowledged and are conscious that that's a pillar that's important, then that's a key thing for me. Because it's what we call sometimes in the industry the Series A trap. A lot of companies will get to where they need to go and get that revenue, but they didn't do it efficiently. And by the time they get to Series A, they need a huge amount of money. And guess what? The cap table, all the stock, it's been gone. Why? Because they misjudged in the previous 3 gas stations how much gas they needed. And they had to circle back to the gas station and put a couple more bucks in to get them to the next one. So if they don't understand their capitalization structure, or more importantly, if they don't understand how to create pillars to look for, then there's no warning bells when they're doing it wrong, which means a company could be basically stuck in the middle of the desert with no gas. Next slide, Andrew. Investing in early stage versus public stocks. I'm going to keep this one a little light for sake of time here. I'll let you guys read on this one, but I think I've collected it here pretty systematically in that how I would go about analyzing a public stock. I'm going to do what? I'm going to go on to whatever my platform is, custodian. I'm going to go online. I'm going to look at the data. They report quarterly. We put a lot of confidence a lot of times. When's the last time you ever asked someone or a broker the value of a stock and then second guessed them and went, are you sure? Maybe I need to double proof you. We don't do that. Private and early stage companies, we do have to be able to do that. And there are also other rules that we have to be able to look at to understand how you're analyzing the data. Okay, so we talked about your ability to set your constraints, then understand what particular data points in the due diligence are your real strong conviction. How do you extract that information in the most time efficient manner? And then the other thing that you want to look at is, okay, now you've extracted the data, how are you analyzing it? And you have to have a particular tilt. When I was on a trade desk in my earlier career, we did all technical analysis on fixed income. Data comes in, we have a particular algorithm or function that we put it through, and if it spits out the other end with the valuation we like, it's a buy, it's a sell, or it's a put in the parking lot. Whatever it may be, it's the same thing that you need to have once you actually built a mechanism to know what you're looking for, and now you've got the data coming in. The only thing that really sort of differs is how you extract and how you analyze. You do not have the ability in the early stage startup process to take that information as gospel. Yet you probably will if it's a listed security. So we've got to be able to balance those. And the other thing, key thing too, is it's slightly different from some of your non-listed but alternative investing, which oftentimes leads itself to more secured assets like real estates or things like that, where you have some level of security and an underlying asset should things go upside down. Startup space, you typically don't have that. The only real asset on paper that most companies may have in those first 3 gas stations is IP. And that's a pretty mixed bag on opinions of how the heck you evaluate that. So how you analyze the data and a tilt. Here's a perfect example. We've got a lot of folks in our industry on the supply side who come from the traditional finance and Wall Street model, and they would do their analysis on the data. They did take it as gospel because, you know, it's kind of silly of the company to give bad information to the markets. And then they'd look at it and look at the track record and discount it by 10% and go, okay, that's where it needs to be. And then they put on their startup hat, they analyze the data, they don't take it as gospel, they go through the investor due diligence process so that they can really get a context, they run it back through the system, and then they discount it by 30 or 40%. Those are the types of strategies, yet similar, but differences of how people actually analyze things. And it all really comes down to the amount of empirical evidence, your ability to feel confident in the team to hit the level of assumptions at a discounted rate. Andrew, excellent. Why take the risk for early stage averages of investing? Let's go through this one. Andrew, if you can hit the next slide for me. So we've painted a picture here, but it also needs to be taken, I think, with a grain of salt, okay? If you looked at most early stage professional funds and they actually showed you the numbers, it's kind of a bloodbath, to be honest with you. There are statistical averages out there that have been written about for many of years that state that due to the high level of failure rates inside of companies in those first 4 gas stations, you know, very small proportion actually make it to the final gas station of Series A. With that super high failure rate means that average funds, when we build a fund, we're looking at least one investment out of around 24 to 26 that will actually hit where we're looking to actually go. And that sounds pretty daunting, right? So translation, onesies and twosie opportunities in startup investing should really be done very carefully if you're not going to diversify that opportunity systematically over time to balance out, okay? Picking a one horse pony here to kind of lead to the promised land could be possible, but it's not very easy. You need a lot of volume of deals to be able to move around. And then typically what this means is identifying how much capital am I willing to play with in startup space, how many investments am I willing to make, and then figuring out what average investment styles are for you. But also too, you have to really gauge it in between competition a lot of times of supply side. So for example, as it says here on the slide, the largest segment is going further down the capital ladder. Capital ladder is those 4 buckets, right? Conceptual, pre-seed, seed, and Series A. As we move up that capital ladder, as we move through those cross-country trips, a larger proportion of your audience is sitting in that Series A space, typically because it's a flight to safety for most investors. It's an area they're very comfortable with, and if they play their cards right, they can bump that company quickly into a public market where they're very comfortable. So they're just sort of dipping their toes into the shallow end of the pool. And if you want to participate in the Series A space, then you most likely need to identify partnerships within the industry because the deal flow gets so consolidated into the primary portals of most of the players. Next slide, Andrew. Statistical averages with early stage investing, as we just covered here, about 25 portfolio holdings. Most professional early stage investors look for a 20 to 30 time return on their money. What are we doing in Verlin? Okay, I have an idea of where I find deals and how I analyze them and how I make sure I'm comfortable with the decision matrix of the team. Why am I doing this? We talked a lot about how risky this is. That's my old compliance hat coming out before we ever talked about returns. So why the heck do people do this? Well, a lot of people feel very comfortable in the way that they can actually evaluate teams. I know I do, but it doesn't mean this is my sole bet. So what are we really doing behind the scenes? Well, I told you 20 to 25 holdings sometimes is typically where we need to be at for a fund. what some funds will actually do, and a large portion of your funds in your seed and series A, and it's okay if you want to invest this way, they'll look at it as what we call a carry fund. And what that means is I'm going to invest in 25 companies. But each and every one of those 25 companies, we have to solely believe that the amount that we're going to get when this company is sold is so high that all other 24 companies could fail. We could have just one success and the fund will still be able to carry its returns to its shareholders. That's a tall order. It's a very tall order. And it's actually how a lot of the industry actually operates. That's the way they hedge against the risk that of a portfolio of 25, 24 can fail. But here's the why I bring this to your point is that you do not have, if you're individual investors, the beautiful thing about it is you don't have the confines that we have of shareholders and high returns. When we're looking at 25 holdings in a fund, we're looking to jump in at whatever gas station we determine as our spot. And we're looking in an ideal world for that company to actually get sold, or what we call exit, within typically 7 to 10 years of that time frame. And the minimal average return that we're looking at in that time horizon of 7 to 10 years is 30 times what we put in. People will go, that's pretty good. Anything above that, yeah, you're bragging about it like a golf score. That's pretty much the way it operates. And so that's a lot of return within a particular period of time, because that's the standards that were set. But if I don't have those obligations or standards, I always caution investors, there's nothing wrong with, there's so many great companies out there. Remember I said we haven't quantified the demand side? Remember I said there's only 5% that get invested in? Those are the 5% that really smart minds think could get a 30x return in 7 to 10 years. The reason I start engaging more RIAs is going, hey guys, you gotta have a field day here. These people are building pipelines and bringing stuff in, and they're letting stuff hit the cutting room floor because it doesn't hit 30 times. How many investors would be happy if they put $100,000 into an investment, hypothetically speaking, and the company didn't sell for $1 billion, but he sold it for 8 million or 9 million? There's a lot of investors that went, that's a phenomenal return. And the funds and the supply side might look at you and go, it's a good return. I can't do it. I need a heck of a lot more. But if that's just your particular take, that's darn good. So my point is that's the way the industry has settled it. They've created a large populace of demand. And if you are, as an individual investor, understand where the rubber meets the road. Where's the juice worth the squeeze for you? It doesn't necessarily have to be $1 billion exit. There are a million shades of gray that can produce year-over-year returns that would make most stockbrokers and clients with their advisors do cartwheels and Merry Christmas. So really figuring out where you feel your risk and return relate. But I would recommend one thing from my years, couple decades of experience. Don't start with the return you're looking for, because that typically will deviate the decisions that you make on the types of data and how you're going to analyze. Start where you're comfortable, start where those areas of conviction are, start with the process that you're going to use. And then at that point, you got a wide enough compass. Then you can make decisions individually as to whether or not you feel the investment that you make in the way you analyze their assumptions and what that could potentially produce. Then you determine whether the juice meets. It doesn't standard a large scale venture capital fund is. Next slide, Andrew. Pros and cons of early stage investing. Pros are pretty simple here, okay? Great way to support local regions. You guys can read them here or read them when you have a copy of it. Yes, there's high potential returns. Can I tell you something that I would really encourage folks to try? And even if not, this country needs a lot more great mentors. I have found a lot of times, and maybe this is fitting for a lot of you here on the call today, is that those that are interested in or participating typically come from some level of professional experience or own their own business. Chances are you've gained an incredible amount of wisdom through your 2 years and how you've actually earned that money that you're willing to give to this founder, typically a younger founder or team. And one of the great rewarding things about startup is, and I've got portions of my portfolio that, hey, if they make money, great. What I'm really, really enjoying is passing down the knowledge and expertise that I've been able to gain to a team that is coachable and will soak it up like a sponge and is more incredibly appreciative than any event or symposium or conference that I can ever speak in. So a lot of times, pros and cons in early stage investing from an individual investor standpoint has a lot more to do with the good kind of feeling that it gives you to be able to share this wisdom and help someone navigate a road that you've actually navigated before. So as we see in the US, a large surgence of individual investors getting active in the market, what I'm seeing through my lens is a lot of people that said, hey, I made my money doing what this guy's doing. I understand this particular market. I was an executive in that particular industry where his ideal client is my old chair. Like, I could make an investment and get in there and share a lot of these things that I have so that they don't make the same mistakes. So that's just a personal conjecture of mine. You can do it for the return. You can do it for the great diversification. Or a lot of times you're seeing people that say, hey, we need to encourage more entrepreneurship in the country. We need to give greater ideas. We need to give greater ideas to create more jobs and create better economies, other than just those that we believe are going to hit $1 billion, because it's those small and mid times at 5, 10, 20 employee headcount can add up quite a bit if we begin sharing, and also sharing the wisdom between our two ears, I think. Let's talk about cons, Andrew. So cons, extremely high risk, guys. This is a black hole of data. I can't think of, and maybe this is what intrigues me to the industry the most, I can't think of an investment style that is more gut related than investing in startups. You are investing at the conception of ideas. You have to be comfortable in the abstract. And the biggest thing here in risk is the reality of loss, right? You can't shake it. We can't go into this with rose-colored glasses. You can adjust your risk by playing in the different gas stations and the different buckets, right? Because there's more empirical evidence. But my recommendation for people that are dabbling in it is be really intellectually honest with what your expectations are. That's capital that could probably be lost. The only way we know of in the industry to offset that is to diversify it more and more. So the way I balance cons as I talk to individual investors is make a good bet and be cognizant, intellectually honest that it may not work, but don't leave it there. Provide mentorship, provide ideas, provide referrals, do things that can actually make you feel pretty good that you actually helped give someone else a shot, not whether or not they made you $1 million. And if that's something, at least through my experience, that can help balance that risk, and I do think there are qualitative aspects that can come into the way that you analyze risk. It's not always quantitative cost basis and return. Then I think it's an easier way for you to digest, and it's a better lens for you to go into the process with. I see the most now in new funds opening up the concepts of shedding this idea of $1 billion returns. You look at LTSE, long-term stock exchange, latest stock exchange in the US. What is it doing? We're creating a hybrid model for technology companies to build at a path which is best for the business, not for quarter-over-quarter earnings. An entire exchange built by the famous author who wrote The Lean Startup. You have new funds that we're interviewing now who are being patient. They're saying, hey, we'd rather invest in the team and the idea if you can help grow a sector of the market that we're really bullish on, that we want to see grow, and we'll give you 15 or 20 years. Our shareholders are fine with that. So kind of shed those confines of what the traditional industry, I think, is laid out, and kind of don't be afraid to kind of cut your own path. Next slide, Andrew. Ways individual investors can try investing in early stage companies. All right, let's talk about this a little bit. How to invest startups utilizing once your preferred early stage round based upon risk tolerance as well as preferred industry, then you begin to conduct your IDD. Once you've done your IDD, your investor due diligence, you're feeling comfortable, you've confirmed a dollar amount, typically you're going to memorialize the investment, and I'm sure Entrust can share with you about these as I've talked to them about these, of things that can be done by individual investors through their qualified and non-qualified accounts will include convertible notes and safe notes. So real quickly on these, convertible notes, I'm sure you heard of, it's a debt note. You sit as a creditor in the business, it's actually not an equity position. And then you set the terms and conditions with the company that are mutually agreed upon as to how and if that loan is not repaid and actually converted into stock inside of the company. Okay, so that's called a convertible note. Then about 7 to 8 years ago, a pretty small incubator, I say that tongue in cheek, called Y Combinator, very big in the industry, created something called a safe note. Okay, and you got to be very careful with these. That's a whole other webinar. But it is a derivative of a convertible note that allows the investor to make a bet financially that operates initially as a loan, and then they go ahead and set the trigger as to when that particular note will convert to stock. There's no conversation about a repayment. So that's kind of where it kind of walks and talks like a convertible. And then they will set the terms and conditions as to when that dollar amount will convert into stock at the stock price and valuation whenever that company is at the time that they agree the conversion will happen, okay? Other traditional ones is a stock purchase agreement. Okay, we both agree to the value, we both agree the share is X, Y, and Z, because again, you can't call your broker and get the amount, and then you memorialize it in the stock purchase agreement, or also too that I know Entrust does, which is private placement memorandum. So sometimes founders and companies will have gone through the effort and the capital to actually prepare what's called a private placement document, which is really designed to protect both of you. It's like an insurance policy. And essentially what it does is it does everything a stock purchase agreement does, except it's a lot lengthier, a lot of legalese, and it is designed to lay everything out on the table, the good, the bad, and the ugly. Both parties sign that agreement and limits the amount of potential liability that may come later down the road, since we know that a majority of them may not meet the expectations that the investor had at the time of investment. So after you've set the confines and you learn what your path is and you learn the types of things that are really deal breakers for you, you've learned how to extract that data, you learn how to analyze that data, and then you've learned that even if I make that investment after all of that, I'm conscious of what the pros and cons are. Maybe I'm going to decide to invest in a couple of more over time to diversify it. Maybe this is going to be my only one and I'm going to mentor. And this is how you can actually memorialize it, both through your qualified and non-qualified accounts for that matter. Next slide. How to get engaged with early stage investing. Here's what I recommend. Remember, this all comes down to a pipeline. You have what I call active and passive non-professional investors. So everyone here on the phone, I'm assuming we would categorize in the industry as a non-professional. That means you're an individual, accredited or non-accredited investor, and you have to decide your level of activeness. Do you want to be reactive to the process, which means, hey, I'm open to it. I've heard Verlin, I've listened to some other ideas. I got a pretty good idea how I'm going to navigate this, but I don't have a lot of time to go out and solicit. If it comes to me, I'm open. And then you have other individual non-professional investors that say, hey, not only am I open, but I'm willing to slip this into second gear a little bit and spend a little bit of time each month or each quarter building relationships that can bring ideas to me to then put through my mindset and decision matrix that I've created as it relates to investing. So if you're going to be proactive with it, the idea that most investors will go to is your local angel groups and angel networks, okay? You've got about 80% of friends and family deals in the United States do include angels. And the other interesting thing about angel groups and angel networks, a lot of people don't know, according to the Association of Angels, is almost 75% of all angel group investing actually incorporates, or as we call syndicates, with a VC fund. So when you're analyzing angel groups or angel networks, look at how they actually invest and what their other relationships are, because it tells you a lot about their deal flow. Is it a kind of informal collection of individuals that put up a website, takes deals, and then they meet every Wednesday to review them? And if anyone likes them, raise your hand. Great. How much are you going to put in? How much are you going to put in? Cool. We'll create an entity. We'll invest. We invest as one. That's an angel group. Then you have angel networks that say, hey, we've got guys in San Diego and in New York and in Texas and in Seattle, and we all have our own preferences and things that we're looking for, but we share ideas and we share deal flow. So there's lots of different ways, but it gets you in a group of like-minded individuals, you control your pace, and it gives you enough frequency of opportunity that you can have a realistic shot of making good investments. New forms of crowdfunding platforms, Reg CF, whole other concept of webinar, but a great way. You lose the personal group think relationship that you'll get with a angel group or an angel network. It's really a very solo model. Also, too, information in crowdfunding is very limited. You can request data, but oftentimes you're really confined, so be careful with that. Entrust Connect Marketplace, if you haven't seen it, I think it's super cool. They didn't tell me to say that. I plan to be utilizing it with some of the companies that we're actually working with, but it's a great opportunity. So that's a deal flow type piece that you can review opportunities. Then you have other things that are out there like your angel list, syndicates, local investment clubs, things of that nature. It really just comes down, guys, if it's a group that you feel comfortable with, that you like, that share your same like-minded ideas, and really look at their deal flow. Are they meeting for the sake of meeting and call themselves angel investors because it sounds cool on the golf course? Or are they really putting in hard work and actually developing really good deal flow ideas that can present good opportunities for you. You have to be really, really critical in that line of thinking. And next slide, as we're coming to the end here, Andrew. How to get engaged with early stage investing, good rule of thumb, stick to what you know. That's always my preference. Get familiar with tools that are out there like Crunchbase and PitchBook. Both of them are pretty good on the free basis model, although you can pay for them. Start to analyze information. And we utilize those in the beginning. Once you figured out what you're willing to do and not willing to do, that we started the presentation with, then what you begin doing is you want to start familiarizing yourself with the types of players in the market that fit those same parameters, okay? So that's really what I recommend utilizing PitchBook and Crunchbase. If I say, hey, you know what? I come from the insurance industry, so I'm gonna look for anything InsurTech related. I really like the ground level concept, so I'm gonna be friends and family to pre-seed, and I'm gonna stick within this InsurTech model, and I'm gonna be cognizant that it probably overlaps with healthcare as well, so I'll open up myself to those two industries. Then I'm gonna start doing a little bit of groundwork systematically each week. Crunchbase and PitchBook, great examples for this. Just start familiarizing yourself with who's the players, what deals went down in those particular spaces that match your confines, who were the funds, visit the websites of the companies funded, do a lot of research so that you start to get a style for valuations and the amounts raised and who were the players inside. Those are really the best way, other than figuring out how you're going to gain your deal flow and the systematic nature of it, is stay fresh within the industries and the confines that you've established for yourself. It will pay big dividends should you be proactive and find an opportunity, or you're in that reactive mode and something pops on your plate. You want to keep those skills sharp in that particular case. Next slide, Andrew. That was it. Not quite sure how I did on time. I know we had a couple technical issues on my widescreen, but thank you for working with us, everyone, and that will conclude it from my side there.
Oh, Bill, I think you're on mute.
Indeed, I was. Thank you, Andrew. All right, Verlin, thanks for all that information. Stick around. We've got some questions, and I'm sure we'll get some more. Coming up next month, we're going to have another webinar on investing in commercial real estate using private debt funds. If you need any more information on self-directed IRAs, visit our Learning Center, and then we're also on social media. Okay, let's go ahead and jump into the questions. The first few questions on here came from somebody who's left, and they're all for you, Verlin. I'm gonna read through these. It's all from the same person that was in the middle of your presentation and typing these out. He's logged off, but you know, we send out this we send out a link to the presentation to all of our, you know, everybody who signed up. So you know, he may come back to it. So let's go ahead and answer. Let me read through these. The first thing he says is, how do you think about valuation, art or science? And then he prematurely thanked you and said to add a little color, he's both an investor and a founder and find valuation to be a pretty subjective, and he put in quotes, sales process. And then another question, if you need it, with all the due diligence at the Series A stage, why do VCs only hit on a very small percentage of their investments? Looking for unicorns rather than sound business and financial models is his question. So that was all came from one person. I'm gonna let you tackle all that before we move on to the next person.
First off, great question, and he nailed it. He's a founder, so it sounds like he's walking the walk. And yes, it is just as much an art as a science. The way that I always ask this, and the founders ask this in our community all the time, of what's valuation? Valuation is subjective. It's in the eye of the beholder. It is the principles, the common principles that funds use, which are very similar, to get to that subjective valuation. That's where you have to focus on. I find too many people on the demand and supply side spending too much useful time arguing about a subjective value, when if you really wanted to get to it, go down deeper into how it's valued, okay? So for example, and he may also be speaking of, it's the sales process he referenced. What he oftentimes meaning is, if you're lucky enough to get to the end of the due diligence process, and now everything checked out, and now it's a matter of connecting on the proper deal terms, which typically relates to valuation, we see a lot of times where things butt. It's part art, it is part science. More importantly, it's subjective. Whenever you try to get one over on another person in a subjective manner, you're basically going to end up standing in the same spot. So my recommendation to cut through the noise is get down to the very basic principles of how you came up with the valuation. So for example, we're obviously off a little bit. Let me tell you our valuation methodology. These are the data points that we use to create that valuation. What data points did you use? And when you start breaking it down in individual steps, what will become very clear is the particular aspects of the valuation methodology for which you're different. Those are the points for you guys to negotiate on. Don't negotiate on the big value because you're never going to get anywhere. And the other part of the question was, why is it that such the big VCs, and as he referenced, because he knows Series A is the largest component, as we talked about, why is it that they feel like they're so selective and picky? You know, of are they trying to find the unicorn or best business model? And I hope that you were able to come back, whoever you were, to watch, because we touched on this with the changing environment of the long-term stock exchange and other funds who are looking more wide in time horizon. So yes, you are correct. A lot of this, because of the risks involved, the industry for a very long time only focused on those carry one models of the funds, of investing in companies that they think could lead them to the promised land and carry every bad and other investment that they made in the fund. So that's what created your selectivity. However, if we get a lot more involvement from individual investors, like many of you watching and many of the other Entrust Group clients over the following years, you'll get broader diversity because there are people out there like new funds that are willing to make bets and give longer time horizons. What that means is they're widening their scope and opportunities. They're willing to bet on people that are beyond their ability to generate $1 billion, but it is going to take some time for the industry to come around to that as a standard.
Okay, next one is also for you. In your interviews, did anybody bring up asking early stage founders about potential exit strategies? Is that a subset of the valuation and capitalization structure?
Ooh, we got some good questions. I like this. Yes, absolutely. One of our topics actually is financial projections, capitalization structure, which is the cross-country trip, and exit strategies. Exit strategies is always something that is discussed in a due diligence process for most investors. It's usually the most shocking to our founders because they're thinking, why are you asking me a question that I can't predict? This is the very reason, everyone, why I talked in the very beginning is it's not whether or not you can predict it. I'm exercising your ability to understand the future and how you analyze it. That's what I have to drive with. Exit strategies from our particular point are very simple. We look at the size of the market, we look at the number of competitors, we look at where he's coming in, and we say, okay, if he's 30% successful in what he says in the next 4 years, is he capable of creating enough of a threat to these particular folks? What's his valuation? And is the market valuation of the other companies make it a viable opportunity for them to basically buy him as opposed to compete and sling mud with him? So we do a lot of discussion in our interview topics about how you build exit strategies from the supply side, and then more importantly from the demand side, how you don't tell people what's going to happen in the future, but how you tell them that you keep a pulse every quarter and every year of how the market is changing and whether or not you have to adjust your exit strategy. We as investors want to make sure that your head is on a swivel, that you can walk and chew gum at the same time. You can meet the numbers, you can grow the business, but you're also always paying attention to the decisions that you make and what that means into the future valuation of the company. So it has to be exit strategy on your brain at all times and every move that you make.
Okay, Verlin, again for you. Is equity analysis, I hope you understand this because as far as I'm concerned, I'm reading like a completely different language here. Is equity analysis less effective in the FANG epoch? Do you know what he's...
Gosh, you know what? I got to admit, I'm not going to admit that I know everything. You'll have to explain the acronym for me in the FANG epoch because there's a lot of rabbit holes that we get into in theoretical study of venture capital space. Yeah,
Davon, if you want to expand on that, but it's spelled, FANG is all capitalized and then APEPOC. Yeah, okay, maybe we can come back to that if he's got more. We only have one more question. And this is again for you, Verlin. This is unusual. There's usually a bunch of self-directed IRA questions, but I guess the people here are very, very focused on the early stage investing. Although I might have some input on this one. It says, please address crowdfunding platforms like Net Capital. The law changes last year have really opened the doors for that. I'm gonna comment here first, and Okay, yeah, all right. So we'll come back to that FANG thing. Somebody just wrote something. The crowdfunding platforms have been able to invest in, into privately held companies for a while now. That went into place with the Jobs Act back 8 years ago, I want to say,
Yep.
in which, people started using Entrust accounts. So, I mean, we have a number of crowdfunding platforms and portals who do refer people to us. So I'm not sure. I'm not aware of anything that changed
There was
last year.
there was a
So Vern,
small.
I'm gonna let you jump in. Yeah, but I'm gonna read it again. Please address crowdfunding platforms like NetCapital. The law changes last year have really opened the doors for that.
So I'm going to say this very cautiously, okay, because I'm very opinionated about Reg CF. But if you can hear me out on this one, Reg CF did come about Jobs Act under the Obama administration many years ago. We had a slight adjustment that was some of us in the industry would consider whether even an adjustment on crowdfunding, and it was associated with the clarification on accredited investor rule, which is what I think this person is referencing. And what it did is it adjusted and played with the qualification of how much you can contribute based upon who you are and how much you make and things of that nature. Does it move the needle, those amendments? In my professional opinion, no. Here are the things about crowdfunding we have to understand. We are barely touching the surface of what crowdfunding is used for. It is still an infant. There are not enough signs of empirical evidence. Crowdfunding is where on the gas stations. It's typically in the first 1 or 2 gas stations. You need time to figure out whether or not that worked. What has happened is a lot of people have taken the solace because it's very difficult, put themselves up on crowdfunding sites and said, okay, do it for me. And then what you had is you had a bunch of actual companies join. Then the crowdfunding sites like Kickstarter, and we've had a number of our portfolio that have been successful in Kickstarter, so I'm not speaking badly, but what they started doing is they started realizing going, oh, wait a minute, there's a lot of companies on our website. So then they brought in algorithms. And then you know what they did? They started figuring out going, wait a minute, if a company is raising $100,000, if they can get to 30% subscription rate by 90 days, the probability of them closing the round gets very good. And that's good for us because now we're showing people that we actually can close deals. So guess who started making it on the first and second page? It's people that opened the round that had high successful rates. Well, then that algorithm actually got well known. And now NetCap, Republic, all your other ones, I talked to them all, circle up, know all their founders. And you want to know what they do now? When you get approved and you pay the fees, what they highly recommend is a $10,000 to $15,000 to $25,000 marketing fee in social media for you to help drive traffic to their website. That's the real inside baseball. So I'm not against crowdfunding. What I'm against is having unrealistic expectations of what those few $1,000s are going to do for you and posting your company on there. We have to be really realistic. Secondly, you have to know your capitalization space, okay? When you get to professional investor stage, should you be fortunate, you notice that what proportion of those professional investors actually participate in crowdfunding? Very, very small. The reason being is a lot of times what a capital fund is looking to achieve, they don't want 500 to 600 to 1,000 smaller investors in their same sandbox because that could create conflict in the way they want to maneuver the company. So it is not a big enough piece of pie and it's a small amount of money and the terms are preset, which means I can't set my own deal terms. So you don't see a lot of professional investors. If you're having struggles in that friends and family or pre-seed because you're in that type of business that needs a little money so that then professional investors could really get an understanding, then go for crowdfunding along with people you know, but go into it eyes wide open. Simply paying the fee and crossing our fingers typically doesn't lead to a lot of success.
Verlin, it seems like the answer that you gave was much more from a founder standpoint, from the companies that are trying to raise the capital as opposed to an investment standpoint or an investor standpoint. And obviously, a big part of our target audience is the investors themselves who would be watching this to figure out like what to invest in. So from an investor standpoint and those who are looking at the companies that are on crowdfunding platforms like CrowdStreet and some of these other ones, I guess, are you saying that, these are ones who, what would that say from an investor standpoint as opposed to like your opinion of these offerings from an investor standpoint as opposed to the founders?
Good point. So the way I would categorize it then from the investor perspective is it is a deal flow opportunity, right? But go back to the principles that we talked about today of IDD about understanding your constraints, knowing which points of conviction you have, and then being able to unpack that in an investor due diligence process. Then once you have all that, make what you feel is a good offer and then put it through one of the instruments. Everything that I just described, Bill, is very limited on a crowdfunding, because when the founder signs up for the crowdfunding and chooses what portion of Reg CF, they have to disclose everything online. You don't necessarily get all the data that you would really want to look for. The data points that are really important to you may not actually be in there. Look at a majority of your crowdfunding sites, you get a pitch deck, you get a short description, you get some financials. You don't have a lot of opportunity to do your own level of investor due diligence. So that's another flag that I don't like. You don't have the ability to listen to that founder, understand the idiosyncrasies. What you're investing is a concept, an idea, but you don't have the context of the human capital behind it. And so for those particular reasons, I'm slightly cautious from the investor's perspective for the many reasons that we talked about today. However, if it's something that you want to dip your toes in on a smaller amount and then build your own portfolio, and you're going to offset the fact that you can't really understand the human capital as much, so I'm going to hedge that risk by building a larger portfolio, crowdfunding can allow you to position with your company for $1,000 bucks. So rather than giving one company 25,000 bucks, I can spread that across 25 if I wanted to. So there are pros and cons. My personal preference, whether it's $5 or $1,000, I got to see the whites of the eyes of the team. I got to read them to really get a context for these assumptions and numbers that I'm seeing on the screen. But that's my personal opinion, and it happens to be a lot of the opinions of the people in our circles in the professional investor space as well.
But the crowdfunding platforms, if you're already aware, let's say you have some awareness of a company that happens on a crowdfunding platform, at least the platform gives you the ability to invest, right? As a non-accredited investor, right? And I think that was the original intention behind it, was to allow individual investors and not just institutional investors invest in startup companies by giving a platform that the companies themselves can now place on there and allow for individual non-accredited investors to invest, right? So It seems to me that it maybe work backwards a little bit from a standpoint of find the company first and then go to the platform to make the investment, rather than go to the platform looking for an investment to find, might be some of what you're saying.
Well said. Yes, I've known a number of great investors that have set their confines, utilized the crowdfunding since they don't have a deal flow situation like we talked about before, found something, and then did their own homework and actually called the company. And the company was happy to meet with them. And they were then able to take what they found on the website and then revert it back to their normal due diligence style. So absolutely, yes, you could find the company first and reverse engineer the math.
All right, so enough with the crowdfunding. So we got some feedback on the FANG.
Okay.
So one person said it stands for FANG is Facebook, Amazon, Netflix, Google equals FANG. Another person said Facebook, Apple, Netflix, Google, which I mean I think the general thing here remains the same. But and then Devon, who originally asked the question, he also said Facebook, Apple, Netflix, Google. Essentially, equity stocks investors have abandoned analysis and are simply riding the wave. So the original question, which was, is equity analysis less effective in the FANG epoch that we currently exist in, right? Which is the Facebook, Amazon, or Apple, Netflix, Google sort of idea of just finding that company and I guess I'm getting the question now, and maybe you will too, and be able to.
Yeah, I'm understanding. It's a great question, and I would add one more company that really rode this wave of exuberant valuations undefined by empirical evidence, and that would be Uber. So you need a U in there, okay? I can't everything. Want to talk about building hype and such with very little and running debt. You look at WeWork as well, so maybe we want to add a W in there in that particular process. But those are the two darlings that I think poison the well, to your particular point. Yes, we rode a wave over 7 to 8 years that was led by large capital, where the Instagrams of the world I talked about earlier sold for $1 billion and the guys didn't even post a picture. That was actually a defensive play by Facebook because they didn't want Twitter to actually buy them. So a lot of companies, you got SoftBank that came in here with almost $1 trillion that they were moving capital in. Is it still here? Yes. Did we throw complete fundamentals out the window and follow hype? Absolutely. Did it taint the well for a lot of people, and particularly early stage companies, and create unrealistic expectations for them to achieve? Absolutely. However, with that said, I do believe the writing on the wall is that this is going to start to change and we're going to right the ship. You look at Andreessen Horowitz for the first time, a lot of people don't know, in the last 24, 36 months, actually did what no people thought a venture capital would do. They submitted themselves to the SEC and filed for a registered investment advisory license. Why would you do that? That's because you want to provide advice. The long-term stock exchange, who Anderson also backed, actually now promoting the concept of, hey, let's give you the amount of time that you need and don't worry about those particular quarter over quarter. And what that means is every time you get a quarter over quarter earning, you have to keep stacking the valuation. That leads to epoch that you talked about. And then you have other funds that are actually coming out and folks like us at Mindset that are promoting it. So it's gonna take some time. I do think fundamentals are coming back. The other primary reason, I forget the person's name, is time is coming out now on the big players in these portfolios that I told you earlier that were bloodbaths. And although that's private information, we can start to read the tea leaves and it's not good. And if you look at the number of companies that have actually had to phase out or didn't re-up a new fund, it's because they weren't able to actually meet the needs of the returns. They followed too much of this particular FANG model. So I think we need more time for it to phase out, but I do believe reasonable brains is the good news, is coming back within the picture. So that's good. Hopefully it's a trend that continues.
Next question, it says, our founder, so this one actually for me, are founders new self-directed IRA investors? I'm not entirely sure about the question specifically, but what I'm gonna talk a little bit about what you are and aren't allowed to do in a retirement account from a standpoint of investing back into your own company. So a founder, an owner of a company isn't exactly allowed to turn around and invest his own funds back in his own IRA funds back into his own company, right? That's considered self-dealing and that's a prohibited transaction, depending upon how much ownership you have in the company and your role in the company, et cetera, et cetera. But using founders generally would never be able to do that. That being said, the IRS does have a program called Rollover for Business Startups, or the acronym is ROBS, which allows you to use retirement account funds to invest back into your own company. There's a couple rules associated with that. One, the retirement account has to be a 401k. It can't be an IRA. So specifically, you can't do it with an IRA. And the company has to be set up as a C Corp. It can't be an LLC or a limited partnership or anything like that. So we do get some people who are using the sort of the ROBS allowance that's written into the code and invest, taking retirement account funds to help them fund their own company and start up their own company. But again, it's a very specific structure that has to be a C Corp. It has to be a 401k plan and not an IRA. And I have a couple of referrals of companies that specifically will help people do that. So I hope that answered the question. Next one says, the Seed Invest portal has literally thousands of startups, and it is complex determining which one can be potentially profitable for investors. That's not a question, that's a statement. I mean, Verlin, I don't know if you have anything you want to say about that.
It echoes what I just stated, and you're absolutely right. It's coming to a point where it's paralysis by analysis. It's too many. It's difficult to actually weave through. It's like finding a needle in a haystack. And then when you do find something interesting, you'll be underwhelmed in the amount of empirical evidence. But to Bill and I's point earlier, and thank you, Bill, for me clarifying on the investor side, take it for what it's worth, right? Your biggest thing starts with you confining what you're interested in, and then if you're willing to be proactive with it, finding a systematic flow. So for that, Seed Invest can actually do you a solid, where you can do it from the convenience of your own home. Are they going to make your job easy? Probably not. Are you going to be flipping a lot of pages? Absolutely. But if you're going into it with that lens of what specific pieces you're looking for, then you can find those opportunities, put them off into your own spreadsheet is what I often recommend, then begin doing your own desktop due diligence. Look at them online, look at the social media engagement, where are they at? And if the audio is starting to match the visual, don't be afraid to contact the company. Sometimes I will admit founders can be a little skittish on who's on the other end, because you get secret shoppers, you get competitors who get investors to pretend that they're interested, so they'll give them data. So don't be dismayed if they're a little bit guards up, but that's probably the best way to utilize Seed Invest, because Seed Invest doesn't necessarily have an incentive, in my opinion, to index that information and allow you to dial into it. They do a little bit of that, but not enough. It looks like a lot of times just a bunch of stuff thrown up on the page.
What are the mechanics of investing Entrust Group self-directed IRA into a crowdfunding platform, do we still obtain a subscription letter for each investment or subscription agreement? Yes, you would. So what you do is once you have an Entrust account established, you would establish an account through that crowdfunding platform in the name of your IRA. So most crowdfunding platforms, or at least the ones that we work with, will have an option when you go to open an account, and it will ask you if you're investing personally or investing through your retirement account. And then you would select your retirement account, and it would ask you which custodian. You know, hopefully they'll have a drop down that we're among the choices. And then it'll ask your account number, et cetera, et cetera. And now you've got an account established within that crowdfunding platform in the name of your IRA. And then you go, you find the investment you want to make, and then yes, they have to provide so you will be the one to log into the account and to find the investment. And then when it comes time to make the investment, you have to get the investment agreement, the subscription agreement created. It'll be created in the name of the IRA if they know how to do that, and then submitted to us. And you typically are the person who does all that. So the paperwork should go to you and you submit it to us. And then we send the money directly to the company or to the crowdfunding platform. However, you know, depending upon how they work at your instruction. But and that's the key thing is to know is that you establish an account in the name of your retirement account within that platform, and then find the investment, and then they'll provide an investment document. Andrew, I'm gonna let you feel free to jump in and provide some additional color on this last question here, which says, oh, did you already answer that? The one about our the Academy? I see you.
Sorry, I sent Preven and anybody on the call, I sent a link to our event website if you want more details about the spring or fall events this year.
Yeah, right. So they just FYI for those who somebody was asking about the IRA Academy that I had mentioned earlier. All right, that was it, Verlin. That was the last question that we had. So really appreciate it. I did see somebody made a comment that said this was like the best presentation they've seen us do. So, you know, you got that going for you.
Awesome. Thank you. Appreciate it. Thank you for the opportunity. I really appreciate it.
I appreciate it, Verlin, for joining us. And I hope you all learned a lot. And again, these are monthly webinars that we do. Check out the next one, which I can't remember what we said it was about, commercial real estate lending or something like that, if I recall. So I'm not going to be the one hosting it, or else I would know. All right, everybody, have a good rest of your week, and you know, happy investing.